Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, March 25th, and this is the weekly market update. A little bit late this week, had some stuff to do this morning. I know some people tease me in the comments that they're waiting for this to come out, but if I'm alive, I'm going to do it. That's my motto. So appreciate the patience. The disclaimer, as always, anything that you hear or see on this podcast or video is not to be taken as investment advice. I'm not a financial advisor. I'm just a guy on the internet who gets things wrong occasionally. You should do your own due diligence for your investments and when you're allocating your money. It's your money, it's your responsibility. Okay, so we had a couple of viewer questions come in. Occasionally, if the questions are pertinent to everybody, sometimes are more personal. Again, I cannot give you personal financial advice. What I try to do in the newsletter or in the videos is give you the general sense of how I'm seeing things, and then in the newsletter itself, basically how that manifests in various investments or speculations that I make. So please understand that. But when you give general questions, I'm more than happy to answer them. The first one was, at what point does QE fail and the whole system simply collapse? Will they rush to CBDCs? Well, a lot of people won't agree with this, but I believe that people in government and in these bureaucracies always want more control over the population, regardless if they're whatever political party. It's just the nature of the beast of an organization, whether it's government or corporation or whatever. It's going to want to grow, and people inside of it want to acquire more power or wealth or whatever. You simply don't enter the federal government or state government bureaucracy so that you can go there with the idea of shrinking it. I mean, that's just not how things are. And so a lot of people would like to see these central bank digital currencies. They're, like I said before, they're going to be sold as being reducing friction, the ability to transact 24/7, 365, convenience. And what they're going to do is they're going to roll them out. How this probably will go is they will likely roll them out and get people on board, not people like me or libertarians or anybody, but Social Security recipients, welfare recipients. These are low information voters. They have no clue. They just want their money. And so these people are not going to push back. They just do whatever. If somebody gives them money, they go along with it. So it's just the nature of how things are. And so I think that eventually we end up there. A lot of people are moving there. You do see pushback in some countries. They tried to roll out a central bank digital currency in Nigeria, and the people really didn't want it. And I don't know how successful it's been. I know that they reduced the larger denomination bills. You know, they do things like limit the amount of money you can take out of an ATM. They make your life difficult. Okay. And so basically, I hate to say this. I'm just going to start saying this. You're not going to vote your way out of this. If you really want to change it, you need to take up arms. Now, I'm not advocating anybody do that, but that's how real change is made through history, folks. You don't vote your way out of this. If you want to change the power structure, you have to pick up a rifle and do it. That's the history of the world. I'm not advocating for that because revolutionaries get put against a wall 9 times out of the 10 and blasted. So what you need to do, what you can do, is you can diversify globally still. It's possible, although they've been slowly but surely bricking off the rest of the world to U.S. investors. But you can buy farmland and real estate around the world, and you can store money there. You can, offshore gold holdings. There's all things you can do. If you're a small investor, you can, and you're not have enough, you have to have a certain amount of wealth to make that viable. But there's things that can be done. But if you just sit here, yeah, they're going to ring fence everything and force people into this. I don't know the time frame. And of course, do I think that there will be nefarious elements in the government? Yeah, if you have like a, neo-Marxist leftists in control, they will use central bank digital currencies to influence society. If you make these kind of comments like I'm making, well, that would, make my score go down, and I could be, have my funds cut off. Some bureau of, anti-hate or whatever, call it whatever you want, staffed with a bunch of, Marxist leftists, could say, well, you saw that in Canada when the people were exercising, the truckers. They went after the bank accounts. So you almost kind of have that control now, but yeah, this will make it easier. But yeah, I think that would happen. It says here, at what point does QE fail and the whole system collapse? I mean, I have no idea. I mean, I've mentioned before, Felix Zulauf has talked about this. You have why can't the U.S. continue to bail the government and the Fed continue to bail out bad actors? That's what the playbook is. Socialize the losses and privatize the profits. The people that are in the Treasury and the Federal Reserve, they're former bankers. I mean, it's more of this revolving door that I keep talking about: the military-industrial congressional complex, the pharmaceutical industry, and the FDA. And people just don't want to deal with this, people don't want to acknowledge it for the most part, because if you start acknowledging it, you have to realize you live in a BS economy controlled by a lot of, quite frankly, evil people. And there's really not much you can do about it as a small person. You can go vote for Mr. DeSantis or Trump. They're not, these bureaucracies are so entrenched now, they'll destroy anyone that tries to unwind it. And so why would QE fail? Eventually, you would think the laws of economics, but you have to remember what Adam Smith said. This question was posed to him hundreds of years ago, and he responded. I don't remember the exact context. I probably should have looked it up, but they were talking about, decline of a country, I guess, in this conversation. And what Mr. Smith said to the person he was talking to was, you have to remember there's a lot of ruin in a country, especially a country like the United States that's very wealthy and is basically living on the inertia of previous generations of the wealth and abundance they created. So it takes time to dissipate that. It took several hundred years in Rome and other places, but why couldn't they just keep doing what they're doing? No one's pushing back. And so, again, I would expect that they'll just keep running the same playbook that they always run. And, so your commission as an investor or speculator is to understand that and accept it, or choose not to. It's up to you. And if you understand the rules of the game and how it's played, then you can benefit yourself and your family. And that's really your only obligation. Your obligation isn't to change the United States federal government. If you want to run for the school board or state senator or county commission, yeah, you can have some impact there maybe. But, as this is a world of 8 billion people, and I'm not going to get into this kind of segues into my philosophical views on things, which I'm really not going to get into on this investment channel. But I don't think it will fail. Eventually, it probably will. But why not? Like I said earlier, Felix Zulauf said that, you're already at 8-9 billion or trillion dollars on the balance sheet. Why can't you go to 10, 20, 30, or 40 trillion? I mean, what's stopping it? The argument is made, well, you'll sacrifice the dollar. Well, they'll do whatever they have to do, whichever is politically expedient. We've learned that. If you haven't been paying attention, they will violate laws or find new mechanisms. I remember, if you remember, during the pandemic crash, the Fed wasn't really, or the Treasury wasn't really allowed to buy corporate bonds. And so they created special purpose vehicles that were somehow legalese. And they didn't really have to buy that many. They just the perception that the Fed would step in and buy these things. They did buy some, but they'll do whatever they need to do. And we saw that during COVID, the helicopter money and all kinds of mechanisms to buy mortgage-backed securities, treasuries, whatever. And so, yes, I do believe at some point it will fail, but it's impossible to know. Goes on here, another question. How do you interpret the news that Biden will not be buying oil to replenish the SPR anytime soon? Well, why would he do that? I mean, we're going to talk about that in some other slides, that He doesn't want to add to the demand problem. We're already drawing again. We had this period in the first quarter here, late in the fourth quarter into the first quarter of this year, where we had crude builds, a slight oversupply, but now we're drawing again as China's opened up and as seasonal influences on the changing of refining from winter products to summer products is in progress. You're going to see draws now continue. So why would they want to add to that and possibly raise the price of oil? I mean, that's one of the main pain points for any politician is price at the gas pump. Not only that, there are, zealots in the Biden administration that, they don't want to buy any more oil. They think that's a good thing if they got rid of the SPR. I mean, they're not going to say that publicly, but, it's not something I see happening. As a matter of fact, if oil prices, as we get nearer to the election, are moving higher, which is a good possibility, as we get to the 2024 election, don't be surprised if they do another draw. I mean, they'll do whatever they have to do to stay in power. I mean, if you think that there's some major long-term plan that these people are running, then I think you're mistaken. These people are basically have their hand, events are right in front of their face and they react to them. And that's what they do, in my view. So there's no plan here. There's some people, some bureaucrats trying to run their little, net zero plans in the background, but these things are not politically palatable when they start coming to fruition because they blow up in their face and then cause these huge price spikes, which are politically, indefensible. So, yeah, I don't really see them buying any oil. Maybe they will. I don't know. If they did, I don't think they would do it in quantities that would be sufficient to drive the price up. However, it would be some more gusts of wind into the sales of higher oil prices. It wouldn't hurt the price going up. Let's put it that way. If you're already had prices moving higher as you had inventory draws, and then you were, adding to that, I don't think it would be, you'd be pulling supply away from the market and sequestering it in salt domes in East Texas and Louisiana. Okay, moving on. So this was from a CNBC article or web page or article page from 2017, I believe, when they had another banking crisis or some bank issues. And this is when you had, I think at the time she was the Federal Reserve Chairman. Maybe she, yeah, I believe so. I can't remember now. Anyways, maybe she was out of office then and between jobs. I don't know. But anyways, she was quoted here saying, banks are very much stronger. Another financial crisis not likely in our lifetime. So Fed Chair Janet Yellen said Tuesday that, remember, this is 5 years ago, that banks are very much stronger, whatever that means, and another financial crisis is unlikely anytime soon. And I put up here define in our lifetime because here we are in the middle of another banking crisis caused by the Federal Reserve, raising rates at the most rapid pace ever after having a decade of basically zero rates or 5,000-year lows in rates. And so you have this economy that's very, very levered because of the free money that was given away, and a lot of malinvestment happened and a lot of nonsense. And I can verify that just from what I've seen happen in angel investing and venture capital. A lot of companies are blowing up. I've had capital calls, which I haven't honored on some of the companies in my angel and portfolio where people are asking for money because they're out of money. And a business that I thought was doing pretty good out of the blue, I started realizing it late in the fourth quarter of last year because this particular company did a capital call on a note that was paying very high interest. I'm like, why are you guys asking for cash? Well, we just want to. They wouldn't really give a good answer, and I already knew what was going on. I mean, and now I got an email from them in the last week or two where they were filing Chapter 11. So, that's what we're seeing, right? We're seeing now. What's the result of this crisis now? Well, you get fear, you get panic, you get tightening lending standards, which are not going to be productive for the economy because this is a debt-based economy, right? And people need loans for agricultural activities, for expanding their business or what have you, working capital, all kinds of things. If you're in business, you understand this. And, now lending standards are tightening now because everybody's scared. I got a lot of emails in the last week of like, well, how do I buy money market funds or Treasury Direct? And I'm not really going to give a class on this because it's kind of giving advice. You can go to the Treasury Direct website, you open an account, you link your bank account, and then you can go in. They have the auctions every week, and it's not like instantaneous, right? You'll see the date of the auction and then the date that it becomes your T-bill or whatever you buy, and then you can own it. And then when you're making the order, you can. It will ask you like how many times, like say you buy a 4-week T-bill. That's just, do you want to roll it? You can roll it automatically. You can put like 1 week, I don't know, 10 weeks, whatever you want. It'll just keep rolling automatically. Or if you don't, when the 4 weeks is up, you'll just get an ACH transfer back to your bank account that you've linked. And then you can just do it again. Now there's a gap because the auctions aren't every day. And so if you initiate like I said, the date, you might be a gap before you see the money move. Another thing you can do is, like I said, if you trust your brokerage firm and have a money market fund there that specifically invests in short-term treasuries like bills, you have to read the prospectus. See, you have to do some work on this stuff. You can't just assume because you have to be careful on some of these brokerage firms that have banks. I'm not going to mention any names because a lot of times they have automatic cash sweeps for your cash balance in your brokerage account. Now, your brokerage account is separate from your bank account, but if they sweep the money into the banking side of that particular entity, then you could be at risk. So this thing gets a little bit more complicated. See, things, you really have to know what you're doing. And that's, without getting into more philosophical discussions, a lot of people abdicate responsibility because they just assume, well, the FDIC is there, the SIPC is there, the government's there. They have people, they're watching. Why aren't they doing their jobs? Well, it doesn't really help you when you start realizing these people really don't know what they're doing and they're just running this thing by the seat of their pants. I mean, here's a woman that is the current Treasury Secretary and was a Federal Reserve Chairman. Federal Reserve has purview over banks. And, she said that we'll never have a banking. It's not likely, she said. She gave herself an out. It's not likely. And 5 years later, we're having a banking crisis that the Fed created. So, again, I'm not going to bag too hard on the Fed because, I don't really know what goes on there. And I don't know what decisions I would make if I'm in the middle of a pandemic and markets are crashing. Of course, you're going to probably liquefy the system. It's just not politically palatable to let 50 or 60 or 70 years of malinvestment and bad decisions unwind in the middle of a pandemic. It's at this point, it would just be irresponsible. Now, Jerome Powell, in my view, probably shouldn't have taken reappointment to the Fed. He should have walked away when he had the chance, leave the problem for somebody else. But, egos and pride and these things come into play. It's a big deal. You call yourself the Fed chairman, I guess, So anyway, I just wanted to point this out. The next slide kind of, builds on the previous slide. And this was a tweet that this individual put out. It said, the Fed since 2020, in March 2020, they said inflation would not be a problem. In January 2021, they said inflation was transitory, as inflation was increasing. In September 2021, interest rates won't rise until 2024. You remember that. January 2022, recession is needed to lower inflation. December 2022, disinflation has begun. February 2023, a soft landing is possible, even though it's really never happened before, except for once, I think. And March 2023, the banking system is stable. And then this particular individual added this comment at the end, not a single statement was correct. And so we focus a lot, people do in the investment community. You can go on some of these Twitter spaces and they will go on for hours and hours. Really smart people parsing every word that Mr. Powell says or what some Fed governor said in a current speech. I mean, really, these guys have one tool, basically. It's they raise and lower the Fed funds rate. And, what they should do is just let the market set the rate, use the 2-year note to set the rate, which is currently really substantially below what the current Fed funds rate is, which is indicating that money is too tight. But Mr. Powell is on a mission, as we talked about last week, to crush inflation so he's not perceived as Mr. Arthur Burns. And he knows what's going to happen, I'm sure. And so he's hoping that the inflation rate will decrease before he is forced to cut rates. And so we have this current crisis going on, in which it's impossible for me to know the complete ramifications. I mean, on Friday, the last news I saw is that Deutsche Bank was in some trouble. And so these are major banks, right? And they can't, if they fail, they're going to have ramifications throughout the entire banking industry. And again, this whole debt-based financial system is a confidence game. It requires that people have confidence in it, that they have confidence in the regulators and in these Fed people and these government people. And so this is shaking that confidence. And that's why you're seeing, all this money. If you follow the money flows, you will see that, hundreds of billions, if not about around $1 trillion, has moved into T-bills and money market funds. People are going to run to safety. People are going to, shoot first and ask questions later. And so, again, we go back to the discussion we had last week where we said it's not about return on capital. It's going to be, the current question is return of capital. And so people are fearful. And so that's it. And if you're trusting these people to come up with the right answer, like I said, they're just going to react to whatever happens. And they've said that they have the tools. They said they're going to continue raising rates. We'll see. I don't think there's going to be any more rate increases, because I think things are going to start rolling over. But that doesn't necessarily mean it's positive either in the short term either, which we'll show a chart about that. And so this is a thing that I thought was going to blow things up, which was high yield corporate debt. And we've seen in previous financial crises, like during the pandemic and during the GFC, we saw the high yield average, blow out on the upside. We really haven't seen that yet. Although we've seen this move index indicate that it's moving higher, indicating that there's a crisis in credit spreads. I'd have to look up this move index again, get these great charts from Crescat Capital and Tavi Costa. They really, again, I can't recommend any higher if you really want to get into some of the macro stuff. They have those YouTube about once a week. They do updates, and they really have these terrific charts. But anyways, this is, if you remember, I was talking about this when the rate raising cycle started, that, I actually recommended the, I can't remember the symbol publicly, the high yield short fund, which really hasn't done anything. It's moved a little higher, but it's just vacillating in a range. So, I think that, and I'm going to show some other charts, as the economy now is going to move into recession, if it's not already, we're already seeing, as these credit stresses begin to percolate through the system, as credit tightens, as rates are higher now, and it becomes more difficult to roll debt. And if you are able to roll, you're rolling into a higher rate. Okay. These are going to put stresses on a lot of these zombie companies. And, so I expect that this will, this will catch up to this if the previous cycles hold true. But it remains to be seen. I mean, you see what happened during the great financial crisis. The thing that you need to understand is, once this thing peaks or gets near the top, there's tremendous buys here, because not every company will be distressed. But you have to understand something about credit distress in the corporate bond market. Now, I've played around with corporate bonds over the last 10 years, and you can really get some good deals sometimes, but you really have to understand what you're doing. And what will happen is, say, for example, as rates move higher and banks and funds that were owning some of this corporate debt, they need to sell. Well, it's not like you can just do it on your phone like a stock. You can't just go on Robinhood or, Schwab or whatever and say bang, and it's done. The transaction is done before you even, as soon as you swipe the transaction to execute it, I mean, you get the little ding and it's done. It's not like that. In some cases, depending on the bond, you may actually have to get on the phone and talk to somebody and say, well, I'll bid this much between this range. And they have to go out and find the bond sometimes. It's not a liquid market. And so when there's distressed selling, when there's a panic, tremendous opportunity can be, because you get these huge gaps, because people just, when they panic, they just want to get out. And so they're willing to accept, especially if they're in high yield debt, and high yield debt is, being stressed, and there's a perception or panic, then people just sell and ask questions later. But if you try to sell and everybody's trying to do the same thing, the liquidity is just not there. So you get these huge moves like we're seeing in previous panics. And like I said, not every company's, even good companies get dragged down, and then you can step in and buy. During the GFC, there was the ability to buy corporate bonds, high yield, that had 25-30% yields to maturity, and they were with companies that, if you did basic analysis, you said, okay, well, the company's stressed, but it's not going to go out of business. It has the ability to make its interest payments, and then look, it goes back to the question that was asked at the start of this presentation. What the Federal Reserve playbook is. Okay, we can play these games about when they're going to cut, when they're not going to cut. They're going to cut. They're going to reliquify the system. This is the playbook, okay? Will it work this time? More than likely. Will it work the next time and the next time after that? I have no idea, but that's the playbook. As credit stress and financial stress increases and things continue to break, they're going to do what they always do. They're not just going to sit there and not do anything. And once those pressures, you start letting off that pressure, and people start getting that sign and say, oh, here they're back. Okay, they're back, and they're going to help us, and we're going to reliquify the system. Okay, they're not going. I'm not saying it's going to work every time going forward, but it probably will work one more time. That's what I'm trying to tell you. So we haven't seen this yet. I think it's coming, and I think I have some slides here that will kind of give us an idea of why that we're just behind the curve a little bit. So this was part of a Stephanie Pomboy. I kind of like her analysis. She's pretty good. And she was talking about this on a recent podcast about corporate defaults are now starting to accelerate. You see here 2023, this is just through February, year to date. It's giving you the different regions. You see the US, Europe, emerging markets, and you see that we're at the highest defaults since around 2008 or 9. And these are corporate defaults, by the way, debt defaults. And so we're, you would expect that after 10 years of zero rates and all the malinvested, you're seeing some of these companies like Bed Bath & Beyond and others. And a lot of these defaults are in retail. So, and you see a lot of it's here just in the US. The US always dominates because it's the largest economy. And we have a lot of leverage in our system. And so this will be interesting to see. If you go back and look at the last time, which was 2009, 8-9, great financial crisis, well, you see what happened during time, okay? As defaults went up, people panicked. They dumped their bonds, which weren't their high yield bonds, which weren't liquid, and you got a big move. And same thing, not necessarily in the financial crisis or the pandemic, just because there was no waiting. Like in the financial crisis and the current crisis, the Fed's running their old playbook of we got to get inflation down, so we're going to raise rates, blah blah blah. In the pandemic, they didn't wait; they just reacted. It was you'd get on the news every day, CNBC, Bloomberg would be talking about the new facility coming out, this facility, that facility from the Treasury or the Fed, blah, and they just opened the floodgates of liquidity and free money. And so I think that limited really the downside. It didn't allow for the cleansing of the system because they were worried about the system collapsing, lock, stock, and barrel. But as you see, the bite is starting to happen now. We're only in March, and we're already, hitting highs that we haven't seen since the GFC. Here's a chart that shows the yield curve predictability of the Treasury spread and its ability to forecast or let you know when a recession's coming. You see the previous times. I mean, we're going to have a recession. It's just a matter of how bad it's going to be. We'll see. But if we're not already in recession, we very well could be. But yeah, this is pretty predictive, and I wouldn't discount this. Here's another thing. This goes back to 96. This is from Federal Survey of Senior Loan Officers. You see loan demand is the weakest it's been in probably in 30 years. That's not good, and that's what you would expect to see in a banking crisis, a crisis of confidence, a crisis of liquidity. Now, if you looked at the Fed data, I think this was the largest use of the discount window in like 10 or 15 years, like 152 billion. You don't want to be a bank that's at the discount window. That's where you can go to they've opened the window. You take your treasury securities that you have on your books and you can exchange them for liquidity. But the problem is you get basically your name is, promulgated. The Federal Reserve, everybody knows who uses the discount window. And so it's kind of a scarlet letter, because then people assume that you have a weak bank. So anyways, if you do see other folks, I mean, like I said, lending standards are going to tighten now, because why would people are scared, right? And people are scared about counterparties and if the loans are going to get paid back. So this is worse than it was during the great financial crisis or during the pandemic. So that doesn't bode well either. And so this is another Tavi Costa chart, basically showing the FANG stocks revenue growth. So again, I put up here, generals fight the last war. So we have this preponderance, every time that people think that the market's going to rally. We talked about in our base case of seeing in the beginning of this year a pop, which we saw in the markets. Now we're into the drop phase that we thought would happen. And every time that people want to think that the market's turned to these bear market traps, trap rallies. But, why are you buying FANG stocks? There's no profit growth there. They're not growth companies anymore. So I'm not saying that won't change, but a lot of these companies are tremendously overvalued. There is a excellent interview, which I put on the website, and you can go to the Wealthion website. I basically put the link there, the YouTube video. It's free, where Adam Taggart interviewed Fred Hickey. Now, Fred Hickey writes the high-tech newsletter. I forget what the exact name of it is. But this guy's so old school, he doesn't even have a website. You have to send him an email, and he will send you the subscription information. I don't subscribe to it, but I am familiar with his discussion points. Been following him since the tech bubble is when he came into prominence. And he was talking about this. He was talking about, even with the decline that we've had in a lot of these companies like Nvidia and some of these other ones, there's an Amazon, they're still tremendously overvalued on price to sales and, just regular price to cash flow and stuff like that. So the declines that we haven't had the real decline yet. And yet people want to rush back into these things. And so we're going to show a chart here coming up that what usually happens is, we think that the Fed's going to loosen things. They're going to reverse their interest rate increases and probably pause, and if not, cut fairly soon. But that doesn't mean we're back into nirvana and growth stocks are off to the races. In fact, most of the decline in the bear market will happen after the Fed begins cutting rates. And here's that chart. You see here, going back to the 1970s, this particular person in this tweet it says the majority of the decline in these bear markets occurred after the Fed's pivot. And so you see they've lined up when the pivots were. Here's the Fed funds rate, and here is the showing on the S&P index monthly. And you see that after we pivot, after the Fed pivots, typically what happens is that the market declines. That's when the majority, and you see over the after the tech bubble and after the GFC, I mean, you had over 50% declines. Now we were like, everybody kind of got knocked out of the box last year, and now people are just assuming, thirsting for and talking constantly about this Fed pivot, like it's going to bail them out. And what we've seen in the past, for the most part, is when the Fed pivots and begins cutting rates, that's when you see the majority of the decline. So I thought this was very instructive. And so the lesson learned is, don't be in a hurry to commit your cash. You should be in cash. You should be building cash. You should be sitting in T-bills or a strong money market fund that you have confidence in, and you just wait. You just be patient. Don't try to get too cute in front of this thing, okay? There'll be a time to buy. It's not now. It'll probably be later on this year, but or early 2024. So there's no reason to go nuts right now. We have liquidity is tightening everywhere. Credit standards are tightening everywhere. The bulk of the recession hasn't even been realized yet. Everybody can see it coming, and yet when you listen to a lot of these Twitter spaces, and there are a lot of smart people in there, far more intelligent than I am and far more sophisticated than I am, and a lot of them are thirsting for this pivot, like it's going to bail them out, or like it's going to be nirvana again. And what we see here is that we can be looking right after the pivot, we can be looking for declines. Now, eventually, the liquefaction, the reliquefying of the system takes hold, but you're already falling by that point. See what I'm saying? The economy's still contracting and the news is bad. So you're always fighting the last war. The Fed's always fighting the last war. And eventually these things turn around, but we shall see what happens going forward. Again, I don't think we've seen the majority of the decline yet. And so I thought this was interesting. Now, everything has to be taken in context. And so this guy put up on a tweet, Buffett, I put on here, Buffett on when to buy stocks. It says, Warren Buffett on buying stocks when interest rates are high. Quote, this is from I believe the 2000, year 2000 Berkshire letter to shareholders. And it said, quote, the best time to buy stocks has been when interest rates were sky high and it looked like a very safe thing to do to put your money into treasury bills. As attractive as that appeared, it was exactly the wrong thing to be doing. It was better to be buying equities at that time, because when interest rates changed, their values changed even much more. And I agree with this, but we haven't seen the majority of the decline yet. And I think that once we see the Fed pivot, once we see rate decreases, I think, by this time next year, we could be at 1 or 2% in 10-year. That's how fast these things change. And they're just going to be forced into it because the economy is probably going to start coming unglued. You saw the loan growth. It's like below GFC. I mean, this is a credit-based economy that needs constant credit growth, and it's just been choked off. That's the lifeblood. It's like, it's bleeding out. And so I would suggest that another indicator that Buffett uses is the stock market market cap to GDP percent-wise. And it's still, I think it topped out at like 210%. The stock market cap was 210% of GDP. It's down to like 150%. Typically, you don't want to be buying that. It's kind of in the buy zone when it's like under 100%. So I think this is correct up to a point, but you have to stay into context. What I think you should be doing is putting together your shopping list, putting together the companies that you want to buy, putting together your watch list, because the bargains will appear after we get the pivot and get the decline in prices. And so you need to be ready to shift out of T-bills in those money market funds. And that will be the point of maximum pessimism. And it will be so very hard to do that. Let's go back and look at that chart again. I mean, we're going to be at some point saying it's time to buy stocks, guys. And we could be down, 35 to 58% or somewhere in that range. 30 to 50%. People are going to be like, are you nuts? You want to buy stocks? I mean, right now we still have too much optimism in the market. It hasn't been driven out yet. And so I think that, there will be a time where not everyone, but most people will be saying, they'll be swearing stocks off. They'll be saying, just stay in, T-bills and blah, 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 blah. But once the Fed pivots and we get the decline that we should be getting based on, previous history, then at some point, once we're down 30, 40, 50%, it'll be time to start cycling into some of these names that you have already done the work on. Because the buys will be tremendous. At that time, same thing in corporate bonds, like we talked about in high yield debt. I mean, I expect to enjoy those chances to buy certain securities at 20 to 30% yields to maturity. And then, realize something when you buy a high yield bond like that doesn't go out of business. You're buying it at a discounted price because of the forced selling and the higher rates that drove the price down. The company doesn't go out of business. They reliquefy the system as interest rates normalize, or not normalize, but as they cut rates and things normalize liquidity wise, then you get a huge capital gain as people say, well, these high yield bonds are from companies that many of them are from companies that aren't going to go out of business. Of course, I want a 20% yield to maturity, and then the price of the bond goes up tremendously. You can make tremendous capital gains in addition to, if you just want to hold the things to maturity, you make tremendous gains. So, and you're first in line, right, above the equity holder. So during these, I think the thing to remember about Buffett and some of these famous investors that I've studied, and again, go to Compounding Quality, to his Substack, where he has tens of thousands of PDF pages of famous investors writing the same thing. You make your money, your return, when you buy. You have to buy at a discount, and it's going to be stomach churning to step in and say, I'm going to commit, for many people will be tens of thousands of dollars, hundreds of thousands of dollars, when everybody is going to be telling you not to buy stocks. And so you have to be careful when you listen to this, or people put this stuff up. Obviously, they're trying to get engagement, but you have to understand the context. Go back and actually read read everything inside the context of what's going on. And not every time in history is exactly the same. So here's some copper porn. This is why I'm still so bullish. I think this is going to be a decade. When the Fed, what I've told people is when the Fed does reliquefy the system, I think commodities are going to roar, just because they really respond to that. Not only that, just the tremendous amount of underinvestment. And if you really studied the story and what they're trying to do, I mean, they're committed hundreds of billions of dollars around the world to this energy transition, which no one seems to have considered. We've talked about this ad infinitum on this channel, to consider that the minerals don't exist. Now, surely people, and the investment has been made to even try to get them out of the ground. And so what I wanted to point out here in this chart that somebody put up on Twitter, it shows here to the left, 700 million tons. That's the total copper produced over the course of human history. Then if you look at the right, it says 1.4 billion tons, which is twice the amount. And it says that's the new copper needed to reach net zero by 2050. Whether you want to listen to Mark Mills, Simon Michow, other people that have written about this, it ain't going to happen, but they're going to try it anyways. Again, heads we win, tails we win more. There's going to be, how high will copper go before, to incentivize the amount of, even try to get here. Okay. It's going to be a rocket ship. And then you're going to have liquidity behind it. They're not going to back off this Inflation Reduction Act and these net zero goals. It's going to have to be beaten out of people. Okay. And, when copper's 14, 15, 16, 17, $20 a pound, and I'm not saying it couldn't go there. People are going to be like, this is just unaffordable. We've seen that already in solar panel prices and in wind turbine prices. They were falling over time over the last decade because prices for commodities were going down. Yes, there were some manufacturing efficiencies and some design efficiencies, but the majority of the cost improvement for these things were the resources that went into it were cheap and they were falling over time. Now that's reversed. So you're seeing price increases, and this will eventually dawn on people. They'll eventually wake up, but in the meantime, Rio Tinto and BHP and dozen other miners that I can name are going to make bank trying to respond to this. And so a thing, even with all the economic issues that we have, I mean, I think copper's still at around $4 a pound. It's really held in. It's supposed to be Dr. Copper, right? It's supposed to be showing that what do you call it? Reflection of the economy, because it goes into so many things. That's why they call it, it's a good economic indicator. But because inventories are so low and the market's so tight for these commodities, certain commodities like copper, it hasn't really dropped. Now, I'm not saying it won't drop more. I don't know, but I've been a little bit shocked of how well it's held in, and that should tell you something. Do I think that in the next 27 years, you're going to double the amount of copper that was ever mined in the history of mankind? I don't think so. I track this stuff. I don't know where all these new mines are. One thing we've been this has been like an undercover bull market when I'm talking about tankers, right? Especially crude carriers and product carriers. And so you can see, we had basically when the war kicked off last year and the what do you call it? The sanctions started getting tossed about. You saw we had an initial surge in these tanker rates, but the sanctions hadn't really fully kicked in yet on all this. And so the rates kind of pulled back. But then as we went through the year and we're on our 9th or 10th sanction regime, and Russian oil and products have been sanctioned. By the way, the EU and the US are still buying Russian oil. It's a long story. But anyways, I mean, you've basically completely, back here rates were low and steady because you had a relative supply-demand balance between the amount of oil and products that need to be transported from the places of origin to their destinations, and there was no disequilibrium or discombobulation. You could then create all these government-induced sanctions. Okay, whether again, I'm not going to argue if they're appropriate or not. This is what happens, and now you've lengthened the amount of miles that must be traveled so that you can you still need the same amount of diesel and oil to run economies, or relatively the same and growing over time, by the way. But the tanker fleet is not sized for these longer journeys that have to go around. I mean, a lot of the airlines in Europe, for example, are complaining because they have to, when they're flying from Europe to Asia, they can't fly across Russia now. So they have to fly a southern route. It makes them less competitive with Chinese airlines, for example. So you have these kind of knock effects that you can take advantage of as a speculator. And so we have this, basically tanker rates are huge. The profits have been huge lately, the cash flows, and really no one's really paying attention to this. I'm not saying, a lot of these stocks have already moved quite a bit. I don't know how much is left, but I just think this is interesting as an exercise and they're moving higher now. So to levels that, are going to, again, what have they done with the cash? Paid down a lot of debt. They're buying back shares, blah, 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 blah. Like we've talked about, the Walter Schloss, methodology of what you can do with your cash. And so it's beneficial to equity holders. We follow many of these companies. There's probably 3 or 4 of these tanker companies in the portfolio. I'm not saying they have a lot of juice left in them, but it's very interesting, when I see these charts to, if you're down here getting, between break, not even hardly getting anything because you're oversupplied market or whatever, for example, and now you're in a market where, your daily rate on a VLCC to operate, it's like 14 grand a day, and you're getting, close to 100 grand a day, where you're going to have some tremendous margins. Yes, there's been some inflationary cost increases with labor and some other things, but fuel's dropped and that's one of your major expenses. So this is the whole essence, I guess, of being a speculator, is like looking for these government-induced distortions that they insert into the economy. Again, the sanctions are caused by government. I'm not going to dispute whether they're good or bad, but they were put in there. And so the fleet doesn't just grow automatically because you want to increase the travel length of all, because we have to avoid Russia now. Or what you see happening, like I've talked about before, where Russian crude goes to Indian refiners, they refine it into diesel, and then the diesel shipped to the EU. I mean, this is what the game that is played. Because quite frankly, if you tried to sanction that and really shut that economy down of Russia, then the rest of the world's economy would crash too, because you need that crude. And they just wink, wink, look the other way, because you have to have that crude. There's no other supplies. So talking about oil, oil's really not done well. We had some initial, you could see here late in the fourth quarter and into the first part of the year of 2023, we had some builds. That's pretty seasonal. You see that happens all the time. It's nothing new. You have, and now we're drawing again as and we'll continue to draw. And we already still have a tight market. So we had some oversupply. And remember, that's at the margin. So we had some oversupply based on seasonals and some other things, refinery maintenance, all the things that typically happen. Plus, but that's kind of reversing now, what you expect to see. And that's where we're seeing these draws. Not only that, we haven't fixed the underinvestment problem. And now we have China reopening, for example, okay, which cannot be discounted. And so when you see people saying, well, John, you're off your rocker, why are you still in these oil stocks? Well, I mean, I'm just going by history here. If you understand cyclicality, if you understand what happens in the industry, you have these changes in inventory that are seasonal. Now it's been the drawdown in the crude prices has been exacerbated by the general market panic and the lack of liquidity. And that's been talked about also, and that people just sell everything that's speculative. You have a lot of paper traders, and that liquidity has tightened in these markets, and that has a tendency to put a downward bias. But in the end, it's going to trade on fundamentals in the end, longer term. Short-term variations in price of crude are going to be based on sediment and liquidity, just like every other financial market, and fundamentals also, but maybe not as much. And so people are sleeping on this stuff, and we haven't seen the full extent of China's open. We don't know. Demand's still holding up fairly well in the US. I mean, we'll have to see what happens. I mean, you saw, we had tremendous draws over time. Now we don't have the SPR after this last 26 million barrels. As a matter of fact, like in the earlier question at the start of this, when are they going to, typically at this level, they should be buying crude, they being the US government. And so, what's going to continue to happen in China, I don't know. But, the underinvestment problem wasn't fixed just because we had this financial crisis and this, situation. We had a little bit of Russians really didn't back off as much as everybody thought they were going to, although they're saying now that they will. But, we're just have to watch this, okay? But this is nothing new. This is what happens every year, okay? And now we're into these draws, and everybody's not really like paying attention. So we'll see if we get this, global recession that creates this oversupply that can overwhelm everything. We'll see. So this was an article on Twitter on tourists from Bloomberg, and want to point out over here, you see that the scheduled amount of flights, which is already, because of the reopening, is higher. You see here, But it's kind of stagnated if you go to the website that we track all the flights on. But you see up here, says the number of scheduled domestic flights in China for the week of March 14th to 20th stood at 88,000, a 0.6% dip from the previous week. The number of scheduled domestic flights is set to climb by 51% to 133,000 a week over the next 4 weeks, reflecting the end of COVID-19 travel curves and the anticipated increase in journeys. Not only that, I believe on the 26th of March, international flights are slated to begin increasing rather quickly. And so you see the implied jet fuel demand going from around 600,000 barrels a day to around 1 million barrels a day. That's just jet fuel. Now, I would bring to your attention, this person chose not to highlight the next blurb, but it's worth considering. This is why you have to watch this stuff in real time. However, the scheduled number of flights and implied jet fuel demand over the coming weeks may not materialize. Since the early days of the pandemic, China has routinely cut several thousand scheduled flights a week or so before the intended departure date. So go down here to the last blurb. It says Spring Airlines, China's largest budget carrier, has expressed concerns that the Chinese air travel demand has yet to fully rebound, plagued by logistical and administrative challenges. So we'll see. That's why we track these things. But if things come off like they're supposed to, and you see international flights increase and domestic flights increase, then you can see implied jet fuel demand going from a little bit over 600,000 barrels a day to 1 million barrels a day. That's 400,000 barrels a day in a market that's already drawing substantially. So again, you have to watch things, you have to pay attention, and we'll see how it plays out. I did see that one city in China shut down, had some what do you call it? Another lockdown, but it wasn't for COVID, it was for the flu. And what I didn't realize, this particular commenter on this podcast, which is a China expert, said that you have to understand China did as part of their policy for influenza or any of these type of respiratory viruses, even before the COVID pandemic, they would utilize lockdowns. I wasn't aware of that. And so they're not averse to, in certain situations, locking things down to try to minimize an outbreak. And so we need to keep that in mind too. Although I haven't seen any major news about them locking the whole economy down again. So this is an older article. I'll put a link to it in the show notes. It's talking about the China National Nuclear Power Company announces largest ever annual investment plan on nuclear power. You probably already heard this news, but they recently unveiled its 2023 investment blueprint, which is 60% year-on-year increase, also marking the highest annual investment since it was listed on the stock market. According to the announcement, the annual investment plan was devised based on the company's development and operational projects, which will cover various sectors of nuclear power, multi-purpose nuclear energy, new energy, and other investments in fixed assets and program acquisition. It says in 2022, their annual investment was 50.63 billion yuan, and see up here it's 80 this year, so that is around a 60% increase. This is a total of 199 billion kilowatt hours of electricity was generated, 16 billion more than 2021 levels, and a 9% year-on-year increase. So this is bullish. More, nothing slowing down as far as nuclear power development. And this kind of segues into the next slide. Somebody put this up on Twitter. I will put a link to the Twitter, what do you call it? It's like 20 tweets in this thread. It's called Twitter thread. And what this was I didn't realize this. I forgot about this. But on MacroVoices, and I'll put a link. I'll go back and find this also. But MacroVoices interviewed Michael Alkin back in 2020, and this was some of their internal work that was presented as a presentation that was downloadable. And, if you're familiar with MacroVoices, Eric Townsend does these interviews, and part of it, they usually post a chart pack when the people come on the show. And I guess this Sachem Cove Partners presentation, which is 2.5 years old now, or two years and 3 months old, was posted, and I think you should take a look at it. It's pretty interesting to review the thesis and then fully understanding, what they were saying. I found it interesting. I'm going to go back and listen to the interview myself. I remember hearing it, but I can't remember so it's good to look at some of these things and see, if you go through the chart pack, which that Twitter thread has, and I'll put a link to it. You can't say nothing's really changed except for things have gotten better. Again, guys, a big reason a lot of these junior mining stocks haven't really done anything, and have actually why uranium juniors are down quite a bit, is because it's the liquidity situation. You pull this liquidity out of the market, which is what the Fed's trying to do. Not only them, the rest of the central banks in the world. You're pulling the oxygen out of the room. And a lot of these things, they don't have real earnings and sales, and they have a tendency to, run on fumes and run on, aspirations and perception, and they need liquidity. And when you suck liquidity out of the room, when you create, price dictates sentiment. Price feeds directly into sentiment. If prices are going down, then people have negative sentiment towards a particular stock or industry. That's what you're seeing right now. But it's imperative, if you're going to win at this game longer term, that you pay attention to the fundamentals, because, as we've said before, and as people smarter than me that are billionaires have said, Stan Druckenmiller, liquidity and sentiment drive prices in the short term. In the end, fundamentals are what drives these things, okay, in the long term. And so, again, if you bought these things at the top, if you bought these things recently in the last, 6 months or so, then your returns are negative. Again, I'm going to ask you, most of the people that listen to this channel already know these questions that I ask, or know what I'm going to say. If you contact me and say, well, you're supposedly bullish on uranium, why are the prices going down? The uranium stocks don't care what you want them to do or what you need them to do. They're going to do what they do. And I'm going to ask you, well, if you bought uranium stocks in the last 6 months or a year down, why did you buy them? And you should be able to, within 3 to 5 minutes, give me the whole thesis. And if you bought them because I said they were bullish, or Justin Hune said he was bullish, or Cuppy said he was bullish, that's not a good reason. Then you deserve what you get. If you can, remember when Rick Rule became a billionaire, part of the reason he became a billionaire was his trade on Paladin. You have to remember something. This was during the last market. People talk about this legend that, the stock went down 90% while he was holding it, and he reloaded many times because he had confidence. It was the same thing with the guy that's in Australia, I forget his name, that bought Paladin also because he knew John Bischoff. I think that's the guy's name that was the CEO, Borshoff. And he knew the guy personally, and he had confidence that he was going to build the mine, and he was going to, and the guy was like a local contractor, and he became a centimillionaire, multiple centimillionaire, because again, in the short term, what is the market? The market is a voting machine. You're getting a lot of negative sentiment. Price goes down, people become negative. Did anything change with the particular company that you're, speculating in? You saw the recent, that's all I can tell you. I don't see anything fundamentally changing for the long term except for the fact that we're in a bear market, and in a bear market, most stocks go down. That's pretty much it. And so I'll put a link to this. You can check it out. You can listen to the interview and, come to your own conclusions. Just wanted to put this out. I think this is the last slide. It's kind of a longer presentation this week, but Ford Motor Company is set to lose $3 billion on the EV unit their electric vehicle unit. It says Ford expects to lose about $3 billion on its electrical vehicle business this year, a reminder of how far traditional automakers have to go in turning their EV portfolios profitable. Ford Finance Chief John Lawler described the EV division as a startup inside the 119-year-old company and said it's normal for a fledgling business to rack up losses. Ford today sells 3 electric vehicles in North America, its largest market. The F-150 Lightning pickup truck, the Mustang Mach-E SUV, and a plug-in cargo van. Quote, startups lose money as they invest in capability, develop knowledge, build volume, and gain share, Mr. Lawler said during a media briefing. While traditional automakers have big plans for electrical vehicles, many are just rolling out their first offerings and generally are losing money on them. Their EV businesses are far from reaching the economies of scale of their core combustion engine vehicles. So I'm going to go back to what Mr. Lawler said here. Startups lose money as they invest in capability, develop knowledge, build volume, and gain share. That's right. That can be pretty typical. Finance chiefs and CEOs lose their job if the company's return on invested capital and assets is, if you're racking up losses. So maybe they have a plan that turns around. But I saw one of these Rivian trucks the other day at the grocery store. When I was walking out, the guy was driving by. That's another company. It doesn't make any money. Who would buy one of those vehicles? Is the company going to be around in a year? I mean, these things need constant money, even with all the subsidies, with all of the zeitgeist, with all of the push behind it of the government and the media and academia and society in general. These things cannot make money. And if you're running a business, at some point, you have to make money or you're going to go out of business. Now, I'm not saying the Ford Motor Company is going to go out of business. They have a tremendous still internal combustion engine division, that generates the majority of sales and profits. But this idea, again, it was the same thing I reported like a week or two ago. Most of the total losses last quarter for the 3 major wind turbine manufacturers was over $1 billion. You have to make money or you're going to go out of business eventually. So we'll see, but continue to follow this. This isn't like just casting brickbats at Ford Motor Company, but this is why Toyota didn't go big into this, because their CEO has talked about this, that he just doesn't see it. And maybe he's going to be the dinosaur. We'll see. All right, guys, that's it for this week. Appreciate the support. Appreciate the viewership. Again, last week was it was one of the highest viewed videos when I put the inflation or die. I guess you really do. I don't like putting those where I put inflate or die. The Fed needs to inflate or die, but that's basically true at this point. And I don't try to put these hyperbolic clickbait type titles up, but that's really where we're going to end up here. When you go into recession, when the credit starts to tighten in a credit debt-based economy, you have to reliquefy it. And if they don't do that, then you're going to have a deflationary depression. And I certainly don't see them allowing that to happen. All right, guys, appreciate your viewership, and we'll talk to you next week.